This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. My name, as always, is Alex Perny, and today we are very pleased to welcome on Chris Vermeulen, founder and CEO of Technical Traders Limited. We're going to be taking a dive into some alternative ways of looking at traditional finance with regards to trading in securities markets. It's something that a little bit outside the scope of kind of what we do in the alternative space, but I do feel it's very important to have a well-rounded view of personal finance. And certainly not everyone is just going to want to plug in and do private securities, real estate as the entirety of their portfolio, while it's not the kind of core focus of what we do on the professional side at Advanta. Again, it's very important to understand how a broad scope of investments can fit into your portfolio, and not just in the traditional sense either. Taking an alternative approach to something that has been around since the turn of the last century, the 1900s, if you will, which is wild to say that that was the 1900s that we're talking about. But in any regard, I always like to have differing viewpoints and alternative ways of looking at things, even if they are in the more traditional realm. So Chris, thank you very much for being on with us today. If you wouldn't mind, give us a little bit of background about yourself, a little bit of background about your company, and then we'll kind of dive in to kind of the traditional view of securities investing in the stock markets and kind of how you are taking a different approach to that people can maybe utilize.
Sure. Yeah. Well, thanks for having me on the show. Well, long story short, I'm Canadian, up just north of Toronto in Canada here. Got hooked into the stock market in finance class in high school when I was 16 years old, and more or less just fell in love with it. It became kind of my sport, my hobby, my passion. I've been doing it for over 25 years. I traded all through college. I've helped about over 25,000 individual traders and investors over the years. And I focus on technical analysis, which means I don't really care about news, fundamentals, anything like that. All I focus on is price action, as we all want our investments to move higher. If they're not moving higher, I use a strategy that allows us to find out how and when to move out of something and reallocate that capital into something new. So and this focus here is focused in the equities market, which really is focused on the U.S. equities market. That is my core focus. And I use ETFs to do that. And I was born and raised in an entrepreneur family, and I've always kind of run my own businesses. I built businesses, sold them off. I do a lot of different alternative assets like real estate, startups, inventions, all kinds of different stuff. So I'm all about alternative investments and generating passive income. And the stock market is one of those alternate investments. And the way that I do it, I consider it an alternate investment because the average person has got, the buy and hold portfolio. They've got money just kind of sitting there maturing. What I do is quite a bit different, and it's an alternate strategy, more or less, to take advantage of the stock and bond market and securities side of things that gives you a lot more control and protection. So that's where my focus has been, because there's a lot of liquidity. It's easy to move in and out of assets, and so that's kind of where I really focus a good chunk of my my time and money.
Okay, fantastic. So again, that's a high level of kind of, the trajectory that you've taken to this position. Now let's kind of look at securities markets as a whole. Everyone's familiar with it. You hear it on the news. Oh, I buy some Microsoft, I buy some IBM, whatever it happens to be, whatever flavor that, floats your boat. What is kind of the inherent issues that you think that the typical investor kind of runs into when it comes to getting involved in the stock market in the first place? Because it's, easy for two finance professionals to kind of, sit, up on our soapbox and say, hey, like this strategy is best, that strategy is best. But from the person coming in kind of at base level, what they really kind of understand is, okay, basic economic principle. I buy at one point, I hold it long enough. Hopefully it generates some appreciable gain in value, and then I sell it. Or maybe they're doing cash flow and they're buying some dividend stocks, whatever happens to be. But let's kind of examine kind of the typical profile, the typical avatar of the investor in the stock market, and what you kind of feel is, maybe broken's the wrong word. Insert your own analogy as to kind of what you feel is wrong with that. But let's kind of, again, frame this out from the person coming in either fresh, or they've just been doing this for a long time and haven't changed their strategy.
Yeah, for sure. So the way I see the way that the masses do things when it comes to the stock market, it's kind of broken into two different realms. So you've got two extremes. You've got the buy and hold, which is just passive, set it and forget it, ride the roller coaster ride through bear markets, financial resets, all that stuff, and bull markets, which to me is a very dangerous strategy if you're in your later years. Yes, buy and hold is great if you're 20s, 30s. But if you want to retire early, you want to control your capital, you don't want to be stuck in some type of drawdown, meaning your money is down 20, 30, 50%, and here you are retired or about to retire, and you lose half of that wealth. The buy and hold strategy carries a ton of risk. And most people don't realize it, although I think a lot of them who are using the buy and hold realize how dangerous it is. Bonds are down more than stocks. They have been absolutely annihilated. And what people thought was a safe defensive play, bonds, is actually the biggest, highest risk asset they could have almost been in for their portfolio. So the buy and hold is very dangerous because, well, long story short is you never really see a buy and hold investor retire 20 or 30 years younger, sooner than they normally do, just because it's average returns. You have a couple assets that do really well. You're also going to have a bunch that do really poorly. And then by the time you net them out, you end up with the average 4 to 8% return, which isn't really anything to get excited about. And then you got the other side of the spectrum of active traders. And the reality is there have been numerous studies, North America, Brazil, Taiwan, that say if you're an active trader, you trade for more than 300 days, even during a bull market, 97% of active traders lose money. Now, I've been, sharing trading signals and things like that for over 25 years, and I can confirm it is a rotating door because people get emotional when they get involved. The more active you are, the more likely you are to lose money. And so there's these two extremes, doing nothing and doing a lot, being very active. Both of them are dangerous in different ways. And what I do is kind of right in the middle of that, is we are just active enough to catch these wave-like patterns that happen in the markets in different assets or sectors or areas of the securities market every year. And I like to think of it as more or less, I'm like the surfer, because I'm a surfer. I'm like that. We're a group of people that are floating out on the horizon. When you look on the beach, the surfers just past the break, and we're just waiting for a high momentum move of something in the stock market, like an ETF, that's got a lot of power to it, a lot of momentum. And when we see something like that, we jump on that wave. We ride the trend using technical analysis. We can identify when it's moving up, how much power is behind it. And when that wave starts to weaken, then we can just kind of carve out, get off that investment and wait for another opportunity. It's not about always being invested. It's about only being invested in things going up. If nothing is going up that meets the criteria, we are literally just waiting safely in cash, earning interest. And so that's kind of, in a nutshell, for a passive investor, this strategy, which is only about 5 or 10 trades a year, seems really active because they're used to doing nothing. For the active trader, they're like, oh, it's not enough trades. I'll never make enough money with that. So it's a strategy that's stuck right in the middle. And that's why I've kind of named it asset revesting, because we're taking our assets and we're just reinvesting it into one asset class within the securities market at a time. We only either want to own stocks or bonds or a currency because one of them is always going to be outperforming and trending better than the other. So we just want to hold the one asset that is moving up. So that's it from a pretty high level.
Sure. And before we kind of dig into that, I want to, kind of frame the current market, because there's a lot of interesting, and depending on your frame of view for it, could be very bad interesting. You could be like, in front of the tsunami wave, or you could be, on the opposite or up the mountain, depending on, what your frame of view is. So one thing that, most people, and especially older generations, kind of feel is a very safe harbor investment would be something like bonds. And from a high level, or from a securities background, really, what are the issues that are framing the volatility in the bond market right now?
Yeah, I mean, the volatility in the bond market is we're seeing a tsunami of people starting to move away from them. They're starting to panic because they're hitting some multi-year lows now. But obviously, the rising rates are just crushing bond pricing. As rates go up, bonds go down. We're starting to see huge volume in the bond market, or the bond ETFs, of investors just starting to give up on that asset class. I mean, I think most of the downside damage has been done. Bonds are down like 45, 50%, depending on which type of bonds you're looking at. But really, this rising interest rate environment and rates probably staying up for quite some time is going to keep the bond market very muted. And it's going to continue to be very choppy. I think a lot of people might be trying to pick a bottom in the bond market, or thinking it's a good time to get invested. There still could be quite a bit of down pricing, lower pricing, and sideways pricing for another year or two. So you don't want to get locked up in an asset that is still clearly in a downtrend and that might not recover for a long time, because there's going to be lots of other alternate investments to get into going forward.
Now, do you feel like the bond market as a whole is, again, it's the price correlation is going to be directly related to increases in the underlying, Fed rates. So if we don't see an appreciable, any more appreciable rate hikes, if we do have new bond issuances now that we have higher interest rates, would that be a signal of price stabilization in this market? Or again, is it just something where there's been so much volatility and there's so much uncertainty around where the Fed is going to go with this? What is your kind of thought on that? Just to kind of give a high level of it.
Yeah, I think I think the bond market is going to, like I said, I think most of the downside for bonds are out. I still think it's going to be a volatile, choppy ride to hold on to them, and I think it could take a long time to work itself out. But more or less, what the Fed is doing, I think, if we do kind of go into this tsunami, this kind of big market correction, the Fed is most likely going to start cutting rates. I mean, they really didn't have any bullets in their gun before in terms of rate cuts, and now they've got so many bullets in their gun that they can drop a quarter basis points over and over again to try to save the financial system and the markets. Which, as they do that, the bond market should start to rally. But overall, I mean, it's still a kind of a dead asset at this time, and they're still not a safe haven play. I think there's still room that interest rates could still actually jump up another 0.5% or percent from here, and that is going to really create a huge waterfall sell-off in the bond market and catch a lot of people by surprise. The market's price action in strong trends, you usually get some of the biggest moves just before a trend ends. So bonds are trading really low, but the bottom could fall out and they could lose another 4, 5, 8% from where they are. So there's a lot of risk still in the bond market, and it's not a place that I would want to be dumping money right now at the moment.
Yeah, and I think, again, the general sentiment for most investors, myself included, is kind of trending that way of, I've never really been a big bond guy. Granted, I don't do a whole lot of equities investing as far as the, percentage of my portfolio that's invested there. But, again, just watching it just as a, trying to stay financially literate has been interesting, to say the least. I didn't expect the kind of cataclysm of pricing to occur the way that it did. I mean, granted, hindsight being 2020, it's easy to see, why it happened. To the degree I'm still kind of surprised about, but again, it's, kind of my 2 cents on it. And the last thing I kind of wanted to ask is anecdotally with regard to the federal, Fed policy with regard to rising interest rates. What do you think is going to be the markers that kind of lead to them curtailing the increased rates? Again, quarter basis points going up. When do you think it's either going to stabilize or start to drop? Is it going to be better numbers for like the CPI indexes? Is it going to be better numbers as far as like housing prices? Because I think that was, again, the main driver for that was, real estate related. But where do you see kind of the markers in the larger economic sense happening to kind of curtail those relatively regular rate increases that we've seen from the Fed?
Yeah. So, I mean, I'm a pure technical analyst, so I don't really follow the news or all the economic data so much. My main focus is following price. I think eventually, the way I have always seen it is, as the stock market starts to break down, consumer sentiment is changing, sales and businesses have already started to slow, and typically that's when the Fed starts to do rate cuts is when the big wealthy people start losing enough money. They try to support the markets and they start cutting rates. And so, yeah, I don't really look at the CPI and all that stuff. I think some of that obviously will play into it, but you never know what the Fed is going to do. We never know what that data is. And I mean, every market condition is so unique. There's always a different formula that they use for that. So my whole thing is, when the market starts to fall and slide tremendously, we go down another, say, 15 or 20% from where we are. The Fed will most likely have slammed the brakes on, for sure not going to be raising rates, and they'll probably be trying to work into their conversation that there's potential they might ease a little bit. They won't want to say too much. They always try to be very cryptic and things like that. But they usually need to see blood in the streets, investors losing a ton of money, and that's when they start to usually kind of come to the rescue and fire out some rate cuts.
Yeah, and again, it's always and you kind of hit the nail on the head. I've always been kind of interested in why they're so guarded with their data and their reasoning behind things. I'm like, I mean, the whole sentiment of the financial markets in the United States has been transparency for the most part. There's a reason that companies have to file all these different things with the SEC and FINRA, all these different regulatory bodies. But the people sitting in the cupola up top are just like, no, you don't get to see this. I'm like, well, it would help. I mean, it would make people like analysts like you, would make people that look at the larger kind of high level stuff like me a lot happier. But again, we can sit and opine about how we don't like quasi-governmental financial agencies running our business, but that's a conversation for another day. So again, appreciate you giving some information on that. I know it's kind of a little bit off the beaten path of what we're really going to be talking about, in that, financial strategies related to things that, again, are a little bit divorced from the traditional buy and hold, people that are looking at just bonds. So again, to kind of recap before we dive into that, the people that don't see as much appreciable risk are going to be the younger population for the buy and hold. You can buy securities when you're in your 20s and 30s and then ride the markets for 20, 30 years and capture that 4 to 8% appreciable growth. Granted, if you're looking at it in the context of inflation, you might be lucky to break even. And that's really assuming that over 20 years, we don't see 4% inflation, which I highly doubt that anyone thinks that that's a reality. So with that said, and again, with the issues with the bond markets, because that's kind of the normal transition, you get a little bit older, you take your money out of securities, you stick it in bonds. It's easy enough to realize, but again, as illustrated by how volatile the bond markets have been, maybe not exactly the best strategy. So looking at these things, and I think it's kind of maybe a fair statement to say, looking at the markets is just kind of a generality instead of looking at price point, and the more analytical side is kind of where you saw the issues in the more traditional sense of things. Would that be correct?
Yeah, for sure. Yeah. So,
and then, sorry to cut you off. But so with regard to that, where's kind of the first steps in when you took that divergent path of saying, okay, this is what I've seen. Now, how are you, again, trying to utilize financial analysis tools, and what kind of strategies have you come up with that play into this alternative way of looking at traditional finance?
Right. So when I first started trading, it was in 1997 is when I kind of got involved in the markets. I was trading small cap stocks. Everything was going up, heading up into that big tech bubble. And I was trading back then, I was trading small caps with good earnings. I mean, all I knew is you want to find companies that are growing and find out their quarterly earnings. And I moved into them. I owned them. I did exceptionally well. And then, of course, the tech bubble started to burst. And even though I found companies that were growing quarter after quarter and meeting the expectations, the estimates, the share prices still got cut in half. And I was just like, this doesn't make sense. I'm like, these companies are growing, yet the share price, I lost half my money or more. And that was when I did a little search online back then. And I found out, there's, instead of fundamental following PE ratios and earnings, I could actually follow technical analysis, following the price charts. Forget everything else. Just follow. If price is going up, you want to own it. If it's going sideways or down, go find something else. And that was when I got into that, because I lost a fortune buying solid companies on good earnings. And I moved to technical analysis. And then I realized, okay, well, now that I can tell that we're in a downtrend, I can profit from falling prices. I can avoid really volatile trendless markets, and I can jump into things that are moving up. And so that's kind of how I kind of navigated into that phase of being like, okay, forget anything to do with just fundamental news, because you never know how the market is going to react to a piece of news. The Fed can say the same thing twice. on 2 meetings, and the market does the complete opposite. You just never know how people are going to react. News is unpredictable. You never know when it's going to hit either. So I completely put zero value in any fundamental or news driven stuff, and I follow price. And so that's the main focus of how I kind of got into that aspect of things.
Yeah, and I think it's a really good point that you make, is that the, kind of external like news and other type of information out there. I mean, again, to kind of just briefly recap, I mean, we talk about the Fed raising the the interbank rates, and as it relates to real estate, that was kind of one of the things we were trying to curtail was, just these insane real estate prices. And that hasn't really affected it. I mean, it's still, in a lot of markets, still kind of a hockey stick from, March of 2020 up into the right. It's just kind of a 45-degree angle on the pricing chart for that stuff. So, and, the Fed started raising rates, what was it, February of this year is when they ramped it up, or was it in the end of last year? In any regard, throughout the entirety of that, it didn't really have an appreciable like marker in that market. I mean, it has in some, but yeah, again, that's a good point. So when you talk about looking at mainly focusing your analysis on price, now for me, that's, and again, I'd like you to kind of expand on this, but when I think about something and just looking at price, it's hard for me to divorce myself from the underlying data. So looking at P&Es, looking at, market capitalization, looking at a lot of different things is where my mind just goes, when I think, okay, right, well, what goes into price? But you're saying that you kind of divorce that analysis of saying, hey, let's just look at price. So how do you kind of take that, trajectory to just looking at price? And again, I would be very interested to learn just how you make that work in a financial, make that work financially.
Yeah, and that's a good question. So, and that's where what I do really stands apart from kind of the traditional. So I look at the markets, I look at them from different time frames because there's different major trends at play, plus there's smaller waves in the market. So you want to know what the long-term trends are, the shorter-term trends are, but pretty much all asset classes. It doesn't matter if, like, to me, stocks, it doesn't matter what stock you own. If you own a stock or an ETF, it's in equities. It's an equity play. It's one asset class. Bonds is an asset class. Bitcoin or crypto is an asset class. Real estate is an asset class. So what I like to do is just look at what the stock market is doing. We've created lots of tools and analytics that allow us to gauge where money is flowing, because everything is related. If money is going out of the stock market, that means the stock market's going down. That money is going somewhere else. And so the markets are interconnected. And so what we do is we find out, where is all that money going? If the stock market's falling, where is it funneling to? And we want to know if it's going into risk on plays. So is it going into something that's highly risky, or is it going into like defensive plays, like maybe utility stocks, gold? Maybe it is flowing into bonds, even though bonds are going down. We want to know where the money is flowing. And so we watch a lot of different assets. We watch a lot of different sectors, because there's high risk sectors, low risk sectors, dividend paying. And we are looking for the momentum. Where's all that money flowing? Just like looking at a set of waves coming through as a surfer, we're like, okay, look at these waves. This money is flowing into these assets. Out of those assets where that money is flowing, which one meets our criteria? Which one is on our asset hierarchy list? So for example, my main strategy is I have an asset hierarchy, which at the top of the hierarchy is the most volatile asset, which for my strategy is the US stock market. And we naturally want to be in the most volatile asset, simply because if it is trending up, it can generate really big returns. But as the stock market falls out of favor, we have different assets going down the hierarchy that are slower moving, lower volatility, they're safer, and they usually trend very, very well. So we might move into bonds, or we might move into a currency. Currencies trend very nicely, or we might actually just want to sit in cash and wait for the current volatility in the market, the chop, to kind of shake itself out, generate a new trend, give us a new set of waves of where money's flowing, and then we can jump back into that. So the strategy is all about trying to be in the most volatile when it's trending, and then moving down when chaos is hitting the markets, moving to slower and slower assets. For example, 2022 was the year where stocks and bonds just tanked, and you could have moved into the US dollar ETF, which moved up just perfectly. It was a very slow trend, but it moved up like 13, 15% through the year. And I mean, a big day on that is like a 0.75% move, 0.5% move. So you can really just continue to grow your money. It's slower, but you're growing your money while everything else is falling apart and everything is really volatile. And that's the key, is just knowing when to step back, when to move over to something that's slow and safe. And then when the markets regain their traction and have clarity, we can shift our money back, reinvest it into a faster moving asset class.
Gotcha. So that's kind of an interesting point that you make, is that you're kind of, from a high level looking at like, trading volumes, where people are selling, where people are buying, because at the end of the day, it's going to dictate price point for the most part. If more people are buying it, the price is going to be higher. Your bid ask is going to continue to go up. More people want it, they can charge a higher premium for it. I think everyone kind of understands that basic economic principle, supply and demand, which is one thing that I do kind of like about what you just mentioned, is that it's nice when, especially for securities, and this stuff can get extremely complicated, that you can kind of grasp some nuggets of, okay, well, this makes sense because of X, and not having to understand the entire rest of the alphabet because these two things hold true to balance your equation. So from that perspective of looking at, money velocities, pricing, what would be kind of the general, and again, I understand and feel free to kind of steer it. I know when talking about trading principles that there can be a degree of secret sauce in this stuff. So again, if my question hits a little bit too close to kind of like the core of this, adjust at will. But
no worries.
Is the majority of this that you're kind of looking at, are they straight buys? And again, or are they kind of built onto option contracts? Is it something where it's being done on margin? What's kind of the general focus of how you do this?
Yeah, so I keep it really, really simple. I have done all the different styles of trading and investing throughout the years, and I found something that works perfect for my style, my personality type, the returns that I want, the risk that I want to take. So what I do is the signals that I generate, they're end of day signals. So the market has to close. We compile our data. We find out, okay, do we have a new signal? If yes, then the next day at the opening bell, we move into the ETF. And I focus just on ETFs. And the nice thing about the strategy is we buy one position at a time. So if the stock market gives us a buy signal, we literally just put 100% of our trading account or our investment account into the stock market, the index ETF. Or if it's in the US dollar, we'll just move into that. So it's a very different strategy in terms of, it's not like we're diversifying. If you own the stock index, you are diversified. You own all of them in there. The stock market moves like the ocean. If the tide goes up, all boats go up. If the tide goes down, boats go down. The stock market is pretty much the same. If it's going up, you just want to own it. It doesn't really matter what stocks you have in general. If it's going down, you don't want anything to do with it, or you want to profit from falling pricing. So we move into this strategy. We use very simple orders. We get a signal. We put it in to buy the next day at the opening bell. It happens automatically. And then from there, we manage our positions. So when we get into a position, we'll say, okay, well, here's our protective stop. If for some reason, the markets go against us and move down to this level, boom, our trade just closes. We close it out and we wait for a fresh new setup. If it continues to rally, then we'll peel off, 25% or 50% of our position when we hit our first profit target. We'll move our stop up, and then we just let the market just keep running, and we hit more targets and move our stop up. So it really comes down to managing your risks, your risk in positions, which most people don't do. This is where most people completely drop the ball, is they always throw a random number into a stock they want to buy. It's not thought out. They don't have stops and targets. They fall in love with what they buy. It starts going down. Nobody wants to sell something going down because then they're proven wrong, and they still might like it. They'll be like, well, if I just hold on to it now, it'll eventually come back, which is a great way to waste a lot of time. That's what the buy and hold strategy is really good at doing, is wasting a ton of time. You can, after the 2000 tech bubble, stock market, the SP 500 took 12 years to come back. The NASDAQ took 16 years to come back. That is a long time with no returns and being down 50 to 85% of watching your money just vanish. So that is a very painful thing. We can always make money back, but we can't get time back. And this strategy just avoids the downtime. If the markets go down, we move to something else. Our account is just consistently hitting new all-time highs throughout the year because we're either earning interest every day or we're in something going up. And we don't have the downtime. Our downtime is us sitting in cash, earning interest, but our account is still growing. And when you can get 5% a year, I mean, it makes it not a bad position to sit in for a month when you're waiting for the markets to, if they're tanking and plummeting like they are now, we can still pull a fraction of a percent out and watch your account go up while we're waiting. So it's, I mean, we're in a really prime condition. This is a huge opportunity, as you mentioned at the beginning of this, the tsunami, this potential major market correction that might eventually hit. It is a huge opportunity. And I mean, right now is the time to, a lot of real estate investors, myself, you can liquidate, you can put your money and make 5% with very little risk. And then we can have this financial reset. And then when home prices tank, as in Canada, where I am, most mortgage rates are 3 and 5 years and people have to renew them. And next year is the 3-year coming up for renewal. And I was talking to somebody who's helping service my car. And he says, "Hey, do you want to buy a house?" And I'm like, not really, but he told me his story and he's like, "Well, I was paying 1.9% on my house. In April, it comes up for renewal. It's going to be a 6% mortgage. I don't even make enough per month to pay for the mortgage at the new rate." And he's like, "I have to sell." And so we're going to have this tsunami of properties coming up for sale in Canada, and the whole interest rates going up. It takes years to work through the system, and it's going to be an incredible opportunity because somebody who's very savvy can say, "Okay, I'm going to start raising cash, make 5%, which isn't that bad. And then when home prices drop, say 10, 20, 30, 40%, you can literally just swoop in with cash or put most of your money down and just refinance later as the rates drop, but you'll get a house cheap and eventually just refinance. So the house is, there's so much opportunity coming around the corner, but it's going to be a slow burn. The real estate market is very delayed from the stock market. We're going to see the stock market crash first. Investors who are heavily invested there are going to feel the pain. Then it bleeds over to homes. And I mean, it's just going to be, we've seen this cycle over and over again. So it's just starting again. It's either you are mentally prepared for it and you're financially prepared for it, or you turn a blind eye and just suffer like the masses, unfortunately. And that's what I'm trying to educate and help people. I'm like, be prepared, because what is happening is very dangerous for your financial situation. It's dangerous for your health. It's dangerous for your marriage. I mean, when financial times get tough, it's amazing. Everything becomes very brittle, and you got to be very cautious.
Yeah, absolutely. And to that point, again, there's, not to circle back around too far on this, but I'm love the real estate stuff. That's why I spend most of my time and what I got a large chunk of my career involved in directly in real estate. And from that standpoint, what my fear is with the crashing housing prices, which again needs to happen to a point for the individual home buyer, whether that's the investor, whether that is, the person that just wants, 4 walls and a roof over their head, is the potential for some of these larger interests, whether it's someone like BlackRock and BREIT, well, maybe not BREIT considering they froze withdrawals the entire year, but like something like that coming in and swooping in and then kind of, whether artificially or just, as a point of fact, just keeping prices high because there's still going to be a demand for it. I don't really know too much about the regulations for foreign direct investment in Canada. I know in the United States, it's pretty wide open. There's not too much of an issue with foreign entities or nationals or, larger governmental organizations buying real estate in our country. So that's kind of my concern, is that we're going to have still a lot of buyers and kind of a price point that doesn't move as much as it does in correlation to the broader markets. But again, that's just maybe a little bit of a tinfoil hat position to be taking on it. But I mean, it's not. And again, the frightening thing I think about that is that while yes, maybe it is a bit of a tinfoil hat position, it's also not so far out of the realm of possibility where someone just doesn't go, "Get some sleep, Alex. You're out of your realm." I'm like, it could happen. But again, let's get back to the topic at hand, because I could ramble on forever for real estate stuff.
Yeah, I love real estate. I own a lot of it. I'm in self-storage facilities. I mean, you name it. It is the great long-term no-brainer. It's one asset class you have to own. And
one, it's great because one, they're not making any more of it. Two, even if the worst happens, it's still there. I like tangible stuff. I live in Florida. Down here, it's beautiful. It's like 73 degrees and sunny right now. But in the past few months, it's natural disaster season where we have these big things called hurricanes that like to spin like a top and rip everything off the foundation. Even if that happens, it removed almost all of your asset, but you still have that asset. There's very few assets where you can carry insurance against the actual structure of the asset. You can't insure a stock portfolio to any meaningful degree. If if Enron happens, if WorldCom happens, you're out. If the stock market goes down and pricing is affected, that directly affects your bottom line. Your house can get ripped off the foundation, and you can be made whole again. That's I like real estate. If it doesn't show in the entirety of this podcast or my career, I like real estate. But anyways, so to the point of what you were talking about the general way that you kind of track, you have, again, markers that I'm sure that is all kind of the more proprietary stuff of like what you're specifically looking at and how you actually determine those market, the things that determine where your positions get rebalanced. But you mentioned that mainly you are plugging into different ETFs for kind of the rebalances, unless it's something like a quote cash position where you're investing in some type of interest bearing fund, if you will. But I think it's one of those terms where I think people sometimes are a little bit afraid to ask. They hear ETF all the time, like, oh yeah, ETF. Maybe define what an ETF is real quick, because again, I think that's one of those kitsch terms that comes out hard and fast. People hear it, they think they know what it is, but from your securities background, what is an ETF at a high level?
Yeah, ETF stands for an exchange traded fund. So for example, if you want to own stocks in, say, the biotech sector, well, you could either go out and buy 5, 10, or 100 biotech companies stocks, and then you say, okay, I have that sector, or you can just go out and buy an ETF, which is a fund that goes out and buys stocks within specific areas. So a biotech ETF would go out and own like a bunch of shares of all the different biotech companies. And so with one position, you could say, okay, I'm going to buy $10,000 of the biotech ETF, and now I have exposure to that sector, and I want to play that move. So ETF is a very affordable way. It's similar to a mutual fund in terms of it groups everything together. One purchase gets you a basket of positions, but ETFs are very low cost. Mutual funds are like 1% to 3% a year to carry those costs. ETFs are like 0.1% or less in some cases. It's pretty crazy how affordable they are. So it just makes it very easy for somebody to get exposure to almost any asset or index or commodity or whatever it is, with one position and at almost no cost.
And just again, to kind of, I think people are very familiar with what the mutual fund is. Besides pricing, what are some of like the big high level differences between an ETF and a mutual fund?
Yeah, so ETFs are they trade just like a stock. So a mutual fund, if you want to move money in or out of it, you have to wait till the market closes, and then they give you a fill. An ETF, you can literally day trade it. You can buy in and sell out seconds later. You can trade it any time of the day. You can trade it in after and pre-market hours. So it's very, very liquid, very fluid. Allows you to give full flexibility. A mutual fund is you pay a lot, you're stuck in it to the end of the day, and then you got to pay a fee to get out of it, and it's not executed till the end of the night. So it's just the mutual funds are just the old archaic way of trading. They're high cost and slow and sluggish. Yeah.
So kind of like the difference between like a DSL connection and a fiber connection, if you will. It gives you the same internet, but one's a lot more, high speed, low drag kind of thing.
Yeah, exactly.
So from that perspective, with regard to, just literally lost my train of thought on what my specific question for the ETFs was. How are these types of assets managed? Are they kind of like a hedge fund where you have managers, or is it just kind of more of like a robotic sense where you have a company that puts together an ETF that says, okay, here's the market that we do. Are these things rebalanced too terribly often for their, like what companies they're actually invested in? Like what's the management aspect? Because that is inherently a little bit of a risk in investing in anything that's not you directly making that decision, as you're turning over some of that control and steering of that ship to another third party. So functionally, How do these things work a little bit?
Yeah, so ETFs, I mean, they're all managed a little differently. Some of them I think a lot of them have quite a bit of automation in them, but they have a prospectus, and they call it a fact sheet, a fund sheet. You look at it, it tells you what the criteria and what that fund is always trying to duplicate or replicate. And as long as you're comfortable with that strategy of what they're doing, that they're going to constantly rebalance, sell some shares. If one company's stock skyrockets in price, suddenly now they're too heavy weighted in there. They might have to sell some of those shares and then use that money to go buy some other companies that it holds. But I mean, it's really just the mutual fund or the ETF managers will rebalance as needed. It's usually nothing drastic. You don't really ever know what's going on. They kind of do it behind their scenes. A lot of them have their own proprietary ways of how they value and what they're moving in and out. But you're more or less looking to buy, when you buy an ETF, it's something that you're comfortable with, what they're doing, what they're buying and holding, and you just let them do their thing. It's just going to try and mimic exposure to whatever it is you're trying to get into. And you can buy real estate ETFs. There's REITs, there's self-storage. It's pretty amazing how you can get into the real estate space, commercial real estate or residential or multifamily and self-storage. And they pay really good dividends. And the nice thing is you can move in and out of them, which I talk about quite a bit, because a lot of people don't have money to, especially right now, to buy into real estate. But you can go buy $100 worth of a real estate ETF every month, collect their dividend payment on your, it's not like you're going to get much with a small investment, but the ETFs allow you to get exposure to you can build a real estate portfolio with a couple $1,000s and have exposure to wherever you want. The problem with it being in the stock market, those companies do fall in value. It's not based so much on the home value. Those ETFs will fall in value. So during a bear market, you do not want to be holding a real estate ETF. They can still fall 50% with the stock market. So there's still a very big difference in how it works. But if you don't have a lot of money and we're starting a new super cycle, a new major bull market, and you can't afford real estate, you can go and buy a real estate ETF and ride that next bull market for 3, 5, 10 years, collect your monthly dividend payments and say, hey, listen, I own self-storage, I've got condos. You can build out a nice little portfolio until you've got enough to go buy your first multifamily property or self-storage facility, which is where my focus is.
Certainly. And, to kind of bring it back a little bit, Center, since we're kind of getting towards the end of this, one thing I always like to make sure we cover is, we cover the risk of the more traditional way of doing things, but also as it relates to kind of your strategy. You indicated that, the ETFs are kind of mainly where you plug in for, what you're looking for to accomplish in a given investment cycle. Now, as far as ETFs as an asset class, they are traded just like stocks, so there is a degree of velocity of pricing on them. But what would you say are some kind of inherent risks that are built into them? Is it going to be, do they get exposure to things like people writing tons of option contracts on them? Do they get exposure just mainly for the normal course of action in their underlying industries as a kind of a mixture of everything? Because there's no such thing as a perfect investment. Besides winning the lottery, hitting the scratch off, there's no such thing as just, perfect 100% upside. So what are inherently some of the risks associated with the specific asset class?
Yeah. So if you own, it really doesn't matter what asset it is, but if you're in the stock market, as we know, it can move very quickly up and down. So the risk is you do nothing and you let things start to fall. They keep falling and you don't take action. You ride that roller coaster down. And a lot of people they don't have the capacity to override their emotions to sell and exit. And then once something falls to a certain point, a certain percentage level, people are like, well, now it's down too much. I can't sell it. They think they can't sell it. They're like, I better just hold it now because a lot of damage has been done. So, if you're investing in an asset that can move as much as the stock market, like you usually don't see home prices fall 25 or 50% in a short window. Stock market does. So you do have to be an active investor unless you want to ride that roller coaster. So your risk is you could experience what the passive investor does, ride something down through through a recession, through a bear market phase, if you don't know how to exit a position and identify trends. And so that's the same risk you'd have as with the buy and hold. Is just you need to take that step to say, okay, we now know the markets have lost their upside momentum. They're trending lower. We need to step aside, let things reset, and then we can reinvest in when it bottoms and shows a new uptrend starting or into a different asset going forward.
Yeah, and I think that kind of is a nice way to bring it in for a landing of specifically kind of, the direction that you like to go with your investment strategy is saying, hey, look, all these same risks still apply, but with this type of asset class, we can, have exposure to a market. We identify kind of the market and buy trends and figure out which ETF kind of fits that model of having the assets that we think is going to go in that direction, purchasing and selling according to that criteria. Is that kind of a fair assessment?
Yeah. And people need to be patient because as we know, all asset classes go through huge waves. We just had this massive asset appreciation across the board in almost everything, and it's fizzling out. And a lot of people think they need to get into like, for example, real estate or into the stock market. I'm like, well, everything has a major cycle at play. I think real estate is going to have a great opportunity a few years from now. The stock market, to me, is still nosebleed pricing. You need to be able to step back and be comfortable with you don't need to be in those right now. I know a lot of people that are like, I need to get a house. I need to get a house. I'm like, I don't really think you do. I think you need to just sit back and wait and then pick the dream home that has everything you want on it, a garage, a workshop, whatever it is you want, right? Because there's going to be a feeding frenzy or a lot of homes coming up for sale, at least in Canada, the way the real estate works. But that's, you just have to be happy, understand these cycles, and you have to be patient and let things reset before you jump in, because real estate is great. But I believe if you bought in the last couple of years, you definitely paid a premium, and it could take a long time for prices to get back up to those after we've gone through a full cycle and wave, versus if you just sit back and pick something up in a year or three from now, you'd be buying it on to me at a fair market value, and you're going to get very instant appreciation plus, rental income and all that stuff.
And with that said, I think it's a good place to come in for a landing because just like you said, if you're investing in anything, it's important to understand what's going on. And if you don't, talk to someone that does understand what's going on, such as yourself. We're going to toot my own horn, or such as myself. If you're interested in strictly the alternatives, talk to people that have been doing it for long enough to understand where the issues lie, how to navigate that stuff, and how to get into a position where it's going to be ultimately beneficial for you, not just in the short term, but in the longer term picture as well. Because you always need to look to the future, look at the past for indicators. But again, past performance is never going to be indicative of future returns. So understanding how to navigate a market of any regard, whether that's real estate, whether that is the securities market, in the context of saying, hey, what does the data right now currently show? And making decisions, one, rationally, and two, with good data, and being able to interpret that, again, is very important. So, Chris, I do appreciate you being on with us today. If people are interested in learning more about what you have going on, how to get more involved with maybe, different strategies you have, or, you are a professional service provider, how can they get in touch with you?
Sure, yeah. If you want to learn more, you can go to my website, which is thetechnicaltraders.com. They can also pick up my book called Asset Revesting at Amazon. And they can learn all about kind of what we talked on in much more detail there.
All right. Thank you so much, Chris, for being on with us today. Again, my name is Alex Perny. This has been the Alternative Investing Advantage podcast. As always, thank you very much for being with us, and have a great day.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.